Home buying 101, the types of lenders, what makes them different, and when to utilize each type. Okay, so first off, I work at Guaranteed Rate Mortgage, which is considered a correspondent lender. Okay, I just want to put that out there first. So here we go. You've got banks, US Bank, Wells Fargo, Bank of America, all those big banks. You've got correspondent lenders, so Guaranteed Rate Mortgage, Loan Depot, Quicken, great. You've got credit unions, Redwood Credit Union, Patelco, you name it. There's a ton of different credit unions across the country. And then you have brokers, okay? So there's differences amongst all of these that are actually pretty staggering when you get into it. And depending on the type of loan program you're going for and your borrower profile, one may be better than the other, for sure. So here we go. Banks, let's start there. So when you're working with a bank, they're going to be handling the process from start to finish. Banks do not broker loans, okay? It's their guidelines, it's their rates, start to finish, that's your choice, which is great. It can be great sometimes, okay? Especially in the private banking world, there's some great opportunities there. And in the private banking world, there are some portfolio loans, and a portfolio loan is a loan that the bank's going to keep forever. Most loans, they're not. They're conventional loans. They're going to sell to Fannie Mae or Freddie Mac. That's what everyone's going to do. Fannie Mae and Freddie Mac are the buyers of conventional loans. So whether it's a bank, a correspondent, a credit union, or a broker, Fannie Mae and Freddie Mac 9 out of 10 times are going to end up owning that note, okay? Where private banking comes into play is if you're, they have specific wealth programs, if you're in the upper echelons where they can do stuff other lenders can't. And that depends on the bank. Some banks have really cool portfolio products for their upper echelon, some don't. So banks, correspondent lender, okay? So that's guaranteed rate, etc. So when I look at rates and I look at guidelines, I'm not just looking at my own. I'm looking at like 20 different sets. So I've got all the big boy banks, and then I've got direct to Fannie, I've got direct to Freddie, I've got, in jumbo, I've got some credit unions, I've got some investors. So basically I have everything under this one umbrella. And that's why I'm at Guaranteed Rate, is because for my clientele, I need options. I couldn't do one set of guidelines, one set of rates. I need options. So when I'm looking at a rate sheet, I'm looking at everyone's rates, and I'm able to choose who's the lowest for that day for my client. Because if you've seen my other videos, you know that investors go in and out on who wants what type of loans. So I never want to be tied to anything. I want to be able to move with the market and move with the appetite for the loans. So the other thing is that like a bank, from start to finish, my team handles it the entire time. So it's my processor. It is underwriters at Guaranteed Rate. It is funders at Guaranteed Rate. We're handling it from start to finish. I have all the options and the control, okay? Now, ultimately, someone else may send you your bill every month. You could get a loan with me and you could end up getting a bill every month from Wells Fargo. That's the nature of a correspondent lender. We're like basically buddies with everyone, getting the best deals for our client. And then depending on the deal, we may keep it with us or our buddy may get it, but that's what a correspondent lender does. So a credit union, I'm actually going to skip credit union and do that last because it will make more sense. So a broker is kind of like a correspondent, but not. So where they're similar to us is they have a ton of options, okay? A ton of options. They can, they've got all these different places where they can look at loans, rates that they can look at, all these different places, except the difference between a correspondent lender, which is what I am, and a broker is that in my case, it's my team, it's my company from start to finish. So the compliance, the funders, everything is my company. Whereas with a broker, they're going to pick who's going to handle your loan long term, and they're going to send the package to that entity, and that entity is going to underwrite and deal with it. Okay? Now, brokers, a really good broker is worth their weight in gold. A bad broker can ruin your life, because what can happen is if they don't know their guidelines, they're going to send it out to like 10 different places when it never should have been a concept to begin with. So, and with like a bank or a correspondent lender, the misery would stop quicker, because it's like, if I send it to my team and it didn't match any guidelines, we would be looking at all the guidelines and we'd be like, forget it. It'd be like a one-time denial. Bank, same thing, one-time denial. Broker, you could get denied 10 times, because if they keep on sending it out looking for a home for it, and that's the negative part of brokering, is when we see bad brokers. There are some amazing ones that are like, oh my gosh, the stuff they can do is crazy. But they have less control than a correspondent or a bank would, but sometimes they have some more options. There are some broker programs that I can't do, and I gladly refer them over to brokers that I trust, so that they can handle my clients and take good care of them. So brokers have all the options, but you better make sure the one you're working with knows their guidelines. Otherwise, it's a disaster. And then the credit unions. So credit unions are a little bit of a hybrid as well. So credit unions have their own portfolio loan programs. And in certain cases, like locally, if there's something I know that we can't do because it doesn't meet any of the guidelines of my investors, I know what credit unions might do it. Okay. And credit unions might do some more unusual things that are local. So they may go, you know what? It's okay that this house has a manufactured and a single family home on it. We know the area. We're comfortable with the risk. We'll keep the money in house and do this loan. Okay. That's where credit unions really shine. Now, that's not going to be a 30-year loan. That's going to be an ARM, an adjustable rate mortgage for sure, because they don't want to keep that loan on their books forever. They want to make sure that they're making money for their members. Okay, fair. Now, beyond the portfolio loans, they also sell generally direct to Fannie and Freddie, just like banks and correspondent lenders do. The only people that don't sell direct to anyone is brokers. Brokers are 100% just putting together a deal and giving it to the entity. They're not selling anything, direct. They're not funding loans. So credit unions also have the ability to do generally Fannie and Freddie, 30-year fixed loans. Government can be hit or miss. It depends on the credit union. Some of them do, some of them don't. Some of them are brokering it out. So that's something you want to ask. A lot of people assume, oh, well, it's my credit union. They're doing it all in-house. Not necessarily. They might be brokering it too. So you want to make sure you ask. So banks in general, all of these in general, you want to make sure you ask how much control you have and what is the timeline, because there's certain markets where you have to close in 15 to 18 days, and there's some lenders that can't. And where we see problems is like, with banks, when there's a ton of refinances, everything slows down, and it's because they're clogged up. With correspondent lenders, it's all we do. All of our company's money is made off of mortgages. We don't have checking accounts. We don't have savings accounts. We don't have any other way to support our business except for mortgages. So we are always trying to move as fast as possible. Credit unions, you can run into the same issue with banks. And if you have, in the broker world, if you have certain entities that really drop their rates, they're going to get clogged up and you're going to see time delays. So it's important to know how much time you have to close, and that can help make your decision. Now, something really important, just because, and this especially applies to jumbo, but I see this across the board. Banks, if you talk to one bank, they can have different guidelines than another bank. Yeah, so in jumbo, when I'm looking for a jumbo client, I'm looking at how many months of reserves are required for each lender. Okay, so what reserves are is the principal, interest, taxes, and insurance. So for instance, one lender may require 6 months, one lender may require 12 months. Now this 12-month lender, if you don't have that much in reserves, they will not touch you, but they're done. So if you had called just that lender and they had denied you and you thought, oh my God, I can't get a mortgage because I don't have 12 months, you're wrong. Call another lender, call a correspondent, call a broker to see what the other options are. Because the one thing I can tell you is that by having access to everybody's guidelines, there's huge differences. And it's not just jumbo. So jumbo is the only one that really requires reserves as a rule. Whenever you're doing a jumbo mortgage, they're going to want reserves. But government, some lenders, and this is another thing with VA, people think, oh, well, all the guidelines are the same. No, they're not. not. I remember when I worked at a bank, I was convinced, because I started off there, I was like, you cannot do a government loan over 43%. It's impossible. I was so cute. Because that was our guideline. I didn't know there were other guidelines that existed. So I thought 43% max. And I would talk to brokers, and this is when I was very new in the business. They'd be like, you're so wrong. And I'd be like, these people are crazy. Yeah, you can totally go higher. It just depends on the investors. Some investors will go up to 50% on government. Some will go to 54. VA is the wild card because VA itself doesn't have debt to income restrictions. So it's really up to the lender to determine what they're comfortable with, how much risk they want. So it's important to note that if you get denied from one place, it never hurts to talk to another place. Just make sure that if you're talking to a correspondent lender, Guaranteed Rate, Loan Depot, Quicken, or you're talking to a broker, that they know their guidelines, because it doesn't matter if the company offers everything in the world. If the individual you're talking to doesn't know the guidelines, you're in the same boat. So bottom line is that regardless of which institution you're looking at, you want to make sure you understand what they're good at and what they're not good at. So I hope this has been helpful. If you have questions, comments, please reach out. And if you need a loan, check out all the states I'm licensed in.